Good morning, everyone. Welcome to the webinar. I'm going to give you about 45 minutes of discussion about the property casualty insurance industry, where it's been and where we think it's going, and talk a little bit about how the U.S. economy may affect the future of the industry. We've got a lot of slides, so I'm going to get going quickly. Start with a profit slide. This is the latest data for 2016, includes only the first 3 quarters. So that's what we show on this chart, and we show for comparability purposes the first 3 quarters of each of the prior years shown here. You see that our measure for 2016 was $31.8 billion, lower than what it was in the 3 prior years. In fact, the peak was not 2015, but you go back to 2007 at 49.4. So 2016 through the first 3 quarters was not quite as good as the prior 3 years, but better than the 5 years before that, going back into the Great Recession beginning in 2008, 2009. Now, if you look at return on equity rather than dollars of profit, as we were just looking at the previous slide, the historical pattern going back to 1975 is that we hit a profitability peak roughly once every 10 years. 1977, 87, 97, 2006, only 9 years there. But we didn't have one 10 years, we don't think we're going to have one 10 years after the peak in 2006 when we get the fourth quarter numbers in. Maybe 2017 will be the profitability peak. It's hard to say, but if history holds, that will be the case. If not, we'll be charting a new historical course. In terms of policyholder surplus, the chart shows you quarter by quarter where we were from 2006 through the third quarter of 2016. And over this period, we had a peak in third quarter of 2007, just before the Great Recession, dropped down to a trough in 2009 first quarter, mostly because of asset value losses. Generally speaking, a recovery with a couple of exceptional quarters, mainly caused by high catastrophe claims. And then a peak in the third quarter of 2016 at $688.3 billion, over a third of $1 trillion of assets in excess of liabilities for the industry. Although I noted in the box over the last 9 quarters that surplus has grown very slowly, a cumulative 2.5% in that slightly over 2 years' time. If we go from assets to premiums, underwriting premiums, the orange line here is the rate of growth year by year for personal lines net written premiums. And you see that it varies. In 2002, there was a 10% increase over the prior year. In 2007, 8, and 9, virtually no increase at all. But it's a relatively muted pattern, especially compared to the year-by-year premium changes for commercial lines, which in 2002 were increasing at about 23, 24%, and in 2009 decreasing at nearly 10%. So commercial lines are much more volatile than personal lines, and the 2 numbers I have for the year 2016 are third quarter numbers. As of the first 3 quarters of 2016, personal lines were up 5.7%, personal lines premiums up 5.7% over 2015. Commercial lines premiums were down 1.3% versus 2015. Now, when you put them all together, what you get is a plus 2.8%, all lines considered, for the first 3 quarters. And this chart shows you the combined effect of commercial and personal lines together for the first 3 quarters. And you see that the growth rate in 2016 was slower than any of the 5 preceding years. You have to go back to basically the year after the Great Recession to find a slower growth than the one that we have so far experienced in terms of our record for 2016. In terms of underwriting gains and losses, the first 3 quarters of 2016 produced a $1.7 billion underwriting loss, in contrast to the 3 prior years, which for the first 3 quarters were underwriting profits. But that's pretty unusual. 3 years in a row, underwriting profits. The last time that happened was in the early 1970s. It's more normal to see underwriting losses of the kind we saw in 2008, 9, 10, 11, and 12. Some of those, 2008 and 2011 in particular, driven by catastrophe claims, but in general, that's the normal underwriting gain or loss that we would typically experience. This chart shows you catastrophe claims. These are annual, not first 3 quarter numbers. And in 2016, the bar represents only the first 3 quarters of the year. It does not include Hurricane Matthew and related 4th quarter claims, which will clearly push the number to over $20 billion, maybe in the low 20 billion category. Compared to, again, the 3 prior years, considerably more in cat claims compared to 2011 and 2012. 2012 included Superstorm Sandy. Then 2016 wasn't quite as bad. Again, we won't know until the 4th quarter data are available shortly, but right now it's probably over $20 billion. If you look at the period from 2001 to 2016, there are quite a few, 1, 2, 3, 4, 5, 6 years in which the claim totals were over $30 billion. And I might point out here that all of these dollar numbers have been adjusted to 2016 dollars. So the numbers that are higher are not inflation adjusted, are inflation adjusted. They're not due to inflation. These are the severity, relative severity indices, and they're generally higher than what they were before 2001. In fact, there's only 1 year before 2001, 1992, Hurricane Andrew's year, when the claims were over $30 billion. And so what we're seeing is a paradigm shift in the direction of greater cat claims on a more frequent basis. And I think the main reason for that is that we have generally put more value in harm's way. We keep building in coastal areas and in other places where storms of one kind or another tend to occur. And when the new buildings are added to the old buildings, you have more damage when a storm strikes that area. Moving from underwriting to the investment side of the house, we'll start with a measure of interest rates, prevailing interest rates. This is the 10-year U.S. Treasury note. The yield back in the year 2000 was a little over 6.5%. You can see has generally been going down, pushed somewhat down by the 2 recessions on the chart, which are the gray shaded areas, but continuing a downtrend throughout this time period with a couple of rises, but those are more temporary than they are long-standing. I've drawn an orange line at the 3% level on the right-hand half of the chart to show you that interest rates for at least the 10-year U.S. Treasury note have been below 5%, below 3% rather, for over 5 years. So if you bought a 10-year bond back in 2007 and you got it to yield something like 5%, it's maturing now. You're going to be reinvesting it in 2017. Instead of the 5% yield you once got, you're now going to be getting 2.5%, which is what bonds today are yielding. And obviously there's a major drop-off in investment income from that reinvestment. As a result of that kind of downshift, the portfolio interest rate on average that the industry has obtained from 2002 down to 2015 has dropped from nearly 5%, 4.85, to barely over 3%, 3.18, almost a 2 percentage point drop. And that is likely actually to continue as the kind of reinvestment that I just described continues to occur. And this will stop and start to reverse only when the yields that are being reinvested are higher than the ones that they replace. That we've got a ways to go before that turnaround occurs. And this is one way to anticipate when it might happen. We have the results here of a survey by an outfit called Blue Chip Economic Indicators. There are 53 econometric forecasters that Blue Chip surveys every quarter, and it publishes the results. One of the things it asks them is, what do you think the yield on the 10-year U.S. Treasury bond will be for the next 8 quarters? And the green line in this case is the average of the 10 most optimistic forecasters. The blue line is the average of the 10 most pessimistic forecasters, and the orange line in the middle is the midpoint of the range of 53 forecasts. Now, clearly what it shows is that everybody thinks that interest rates are going to be going up over this 2-year time period. The optimists think they're going to be going up quite a bit, from 2.5% in the first quarter on average to something near 4% on average for the fourth quarter of 2018. The pessimists think that it will go up only slightly, from 2.4 to 2.8%, and the midpoint of the range of 53 puts them at 3.3% in 2018. So a lot of things can change the forecast that these forecasters have put together, but I thought it would be valuable to show you the range of forecasts and not just the midpoint of the outcome here. Moving to a general economic analysis, this is a chart showing the inflation adjusted, that's real, that's GDP, which is a measure of the goods and services produced each quarter in the U.S. economy. These are seasonally adjusted numbers, so a normal fourth quarter where people are buying holiday presents and doing that sort of thing is not necessarily shown as a strong quarter if that's what always happens in the fourth quarter. This is a chart that starts in the first quarter after the end of the Great Recession, 2009 third quarter, and actually runs through the first quarter of 2017, which hasn't really ended yet, obviously, but the Atlanta Federal Reserve Bank has a computer program called GDP Now, which takes what available information plugged into a GDP estimator and gives you an indicator of, based on what we know today, what the GDP number would be if this were the end of the quarter. The answer for that particular question at the moment is 1.2%. So the first quarter looks like it's going to be a pretty weak quarter, following the fourth quarter, which was a 1.9% gain over the prior quarter. The third quarter of 2016 was a 3.5% gain. That was a very healthy, active quarter, but quarters over 3% are pretty rare. Only 8 times in the last 31 quarters has that happened. And so the new president's hope that he can produce economic growth at 3% or higher on a sustained basis represents a pretty serious challenge, one that certainly has not been met in the last 6 or 7 years. In terms of where forecasters think that growth is going, this again from Blue Chip, instead of quarterly, these are annual forecasts from 2017 for the coming 5 years. Again, the green line at the top is the average of the 10 most optimistic. The orange line at the bottom is the average of the 10 most pessimistic. And the blue in the middle is the midpoint of the range of forecasts which were delivered for the March survey. And again, the pattern is that pretty much everybody thinks we're going to see reasonably steady growth. The only difference is the level of activity. The optimists at the most don't think we'll break 3% on an annual basis. The pessimists after 2018 don't even think we're going to break 2% on an annual basis. None of this includes some of the changes that the President and the Congress will be looking at later this year in terms of tax reform in terms of border adjustment taxes, in terms of changes in the way we finance healthcare and so forth. Those were, at the time this survey was taken, generally considered to be too unclear as to what exactly was going to be put into place. So the expectations are that more or less the existing conditions will flow through here, and that's why you get the forecast that we see in this chart. But we pay attention to the U.S. economy because it has obviously a very good close connection with the net written premiums for the property casualty industry. This chart shows you in the blue lines net written premiums year by year, percent change in net written premiums year by year going back to 1971. There are three hard markets in which premiums spiked. But if you overlook those three cases, in 45 years, nominal GDP, which is the orange line, runs pretty close to net written premium growth for property casualties. So absent an unusual case of a hard market, this is a pretty good indicator of where the property casualty insurance industry's premiums flow may be going. This is a map produced by the Philadelphia Federal Reserve Bank, which I put in presentations because it helps to remind me and you that even though I've been using national numbers up to now, things may be very different if you're in one state or another. The color coding system, which is at the bottom center of the chart, is one that the bank uses every couple of months when it produces a new chart. And so theoretically, it's possible for every state to be colored the same color. The dark green represents expected growth over this period using the variables that are the leading economic indicators in the 1.5 to 4.5% range. So pretty good growth, although that's a pretty broad range of categories. And for example, take a look at Pennsylvania and New Jersey, both colored dark green. Pennsylvania's growth rate, I happen to know, is 1.8% for this period of time. New Jersey's 3.0%, right next door. So the fact that they're both colored the same does not mean that they have a very close forecast for their growth in the next quarter of time. North Dakota is, according to this map, in an economy is going to be shrinking for the first half of 2017 at a pretty rapid clip, faster than 4.5% down. South Dakota, Illinois, Michigan, Mississippi will also be shrinking according to the leading economic indicators, but only between 0 and minus 1.5%. Alaska, over to the bottom left of the map, will be somewhere in the 0 range, minus 0.2 to plus 0.2. Everything else is expected to be growing, but as I said, somewhere in the 1.5 to 4.5% range for the dark green states. Two other ways to look at how the economy is coming along. The Institute for Supply Management publishes an index of manufacturing activity. The values over 50 for the index indicate expansion. Values under 50, contraction. I started the chart in January 2010, a little bit after the recession ended officially. And there have been a number of months in that period of time in which manufacturing was registered as contracting, including August of 2016. But since then, there's been, as you can see, a very rapidly growing, strengthening manufacturing activity level as measured by this index, including the February number, which is nearly as high as some of the highest readings that we have ever seen. So manufacturing is expanding as of the latest measure by ISM. Non-manufacturing, which is what's shown in this chart, after the down in January 2010, has not had a down month ever since. This is the services side of the economy. It's about 70 to 80% of the economy. February was a very strong month, as you can see. And so this is another reason why I Federal Reserve and others think the economy is actually moving along pretty well. I have a chart that I often use showing business bankruptcy filings. And the reason for doing that is that when a business goes bankrupt, all of its commercial insurance disappears. So this is not so much a growth chart, but a chart that shows durability and persistence of business insurance. This is business we don't have to go recreate because we didn't lose it in the first place when bankruptcies occur. These are quarterly numbers. I've colored the quarters that were recessions in a different color so they stand out, and you can see in the 2008-2009 period how badly bankruptcies soared as a result of the Great Recession. In the quarter before the recession started, there were 8,000 bankruptcy filings, business bankruptcy filings that quarter. In the last quarter of the Great Recession, there were 16,000 business bankruptcy filings, double the number just before the recession started. But the good news is that for the last 2 or almost 3 years, the number of business bankruptcy filings has not only come down dramatically, it's actually below the filing rate, which was prevalent even before the Great Recession started under more normal conditions. And so we're not losing business insurance the way we used to because of fewer business bankruptcies. Not everybody's actually happy about this. I was talking not too long ago with a judge of the federal bankruptcy court, and I asked him what were his major challenges, and he said one of them is that they are now overstaffed in relation to the workload that they have, and they have to lay off people because there are relatively so few business bankruptcies that they have to process. So bad for them, good for us. Moving over from the general economy to the labor market, this is a chart that the Federal Reserve has concocted, which tries to figure out when we might be headed for another recession. They combine 19 different labor market indicators into a common index, which I have drawn an orange line at the -20 level of the index, and you can pretty well see that at that level, when the index gets down that low, we're in a recession. So as it starts to go down, that's when we would get concerned that we might be heading for a recession. The latest value, which is for January 2017, as you see, is 1.3, so we're not anywhere near a recession. If you look at the years between the 1991 recession, that's the gray shaded area there, and the 2001 recession, that was a 10-year period in between those two. It's the longest we've ever gone since World War II between recessions. And that's worth noting because here in early 2017, we are 7.5 years into a period since the end of the last recession. So if we go as much as 10 years between, like we did before, it'll be 2019 when the next recession comes. Might even be longer, but right now, as the chart indicates, we are not near heading into a recession. In terms of people newly employed, what I've graphed here is quarterly changes in non-farm employment. I've boxed in 2014 and 15. Those were the two strongest years of new people getting new jobs since 1999. 2016 was a little weaker than that, but I put in a number for 2017's first quarter, which is based on the numbers published for 2017 January and February, and I've assumed that March would continue at the same rate that January and February were. If it does, then the 709,000 people with jobs in that quarter would be a nice number to record. This chart shows you a breakdown between the number of people working full-time and the number working part-time. The bars, the orange bars here, are the number of people working full-time. The scale we're judging them on is the y-axis on the left. And this shows you that in 2003, there were about 113 million people working full-time. By 2008, that was up to nearly 122 million. And then the recession hit, technically December 2007. And the number working full-time plunged to about 111 million in 2010 first quarter, and then started, as the recovery took hold, to rebuild to the point where we are now at a new peak in terms of full-time employment at about 124 million people. Now, if you look at the blue line, that measures the number of people working part-time. The scale on which that's plotted is on the right-hand y-axis. So back in 2003, we had about 24 million people working part-time. It was drifting up a little bit when the recession hit in 2008, and then that spiked. It soared up as people went from full-time to part-time. And at the end of the recession, we had about 27.5 million people who were working part-time. I expected that the rise in full-time employment after the end of the recession would be accompanied by a matching drop in part-time employment, but as you can see, that did not happen. The latest reading, which is the fourth quarter of 2016, we have nearly 28 million people working part-time, which is virtually the same number that we've had for the last 6 years or so. To try to understand what's going on here, I've broken this down into 2 subcategories of part-time employment. The orange line at the bottom here is people who, according to the Bureau of Labor Statistics, are working part-time for what it calls economic reasons. These are people who want a full-time job but can't find one and are working part-time until they do. If you look at the left-hand part of the chart, January 2003, there were a little over 4 million of these people in this category. That stayed about that level, maybe dropped a little bit until the recession began in December 2007, and then soared dramatically up to about 9 million from 4 million, and stayed there for a while after the recession ended, has since drifted down, and you can see that it's down a little bit under 6 million now. Probably not going to get much lower than 4 million ever. And indeed, the working population today is bigger than it was a dozen years ago. So this is moving in a good direction. Now look at the blue line on the top. These are people working part-time, according to the Bureau of Labor Statistics, for what it calls non-economic reasons. These are people who want to be working part-time. They may be working part-time because they're also going to school, or they're caring for someone who needs family care, like an adult, a parent, maybe a child, or there may be other non-economic reasons that they've chosen to be working part-time. In January 2003, there was about 19 million of these people that stayed at about that level, went close to 20 million before the recession. It dropped down close to and actually below 18 million shortly after the recession, but has since been climbing to the point where in December last year, it reached over 21 million people who are working part-time because they want to be or feel they need to be. It's dipped down just a little bit, but still above 20 million in the last 2 months. And so when you add these 2 categories together, the rise in the part-time for non-economic reasons and the drop-off in the number for economic reasons, you get a flat part-time number such as we showed you in the previous slide. Another factor in the question of whether we are at full employment is people who are, according to the Bureau of Labor Statistics, so-called discouraged workers. These are people who are unemployed, they want a job, but they've been looking and they can't find any work, and their attitude is, I'm not going to look anymore until the conditions change, because what's the point? I can't get a job. This number was before the Great Recession, in between the 2 gray shaded areas. somewhere in the 300,000 to 500,000 range. I've boxed it in there. During the recession, this number soared so that by the end of the recession, it was 800,000. Shortly after that, a year or two later, it was over 1.3 million people were discouraged, not even looking for a job. That's come down systematically since then. So that in January 2017, which is the latest data we have, it was about 500,000 people. Clearly from what we've seen in the past, if this comes down a little more, that's good, but it's probably not going to get much below 300,000 to 400,000 because we barely ever had numbers of this kind that low. And again, the population for working is considerably larger than it was 10 or 20 years ago. So the number of discouraged workers is simply likely to be a little greater than it has been in prior years. So all of those factors together give us an unemployment rate. This is the orange line, the headline unemployment, the one the media focus on every month. 4.7% in February of 2017. In the best of the recent years, that is to say the January 2001 to January 2008 or so, we had headline unemployment numbers in the 4.5% to 5.5% range. So 4.7 is in that range. That's why it's in the little blue box there, which you might consider about as low as it's ever going to get. Economists prefer to measure unemployment in a more comprehensive way. The problem with the headline number, for example, is that it doesn't count unemployment among discouraged workers. If you're not looking for a job, officially you're not unemployed, even though you may say that if conditions were better, you really want a job. The U6 number, that's the dark blue line, counts everybody who wants a full-time job and doesn't have one. This number was in the pre-recession years somewhere in the 8 to 9.5% range most of the time. It soared up to 17.5% in October 2009. Has come down to 9.2% in the latest reading for February 2017. So again, this is a number that's pretty much now starting to be in the normal range. And that's why, among others, the Fed tends to believe that we are in a very strong position in terms of the economy functioning close to full employment. Payroll, which includes not only more people working, but actual raises that people have been getting throughout the time since the recession ended. Payroll has been growing more or less constantly since the end of the recession. It's now up to $8.3 trillion. And the reason we keep track of this is because this is basically the exposure base for workers' compensation. It's been growing at about between 3.5% and 5% per year. And so this is an indicator of premium growth for workers' comp. Obviously, this is also a function of the mix of the risk involved in the various occupations that are covered. But fundamentally, this is good news for that part of the property casualty industry. Moving from the labor market, I just want to spend a few slides on the housing market. Housing has generally been thought of as a sector that leads growth in the U.S. economy. This is housing starts. The blue bars are historical numbers. The orange bars are forecasts. And you can see the housing bubble. We were starting about 1.5 million housing starts a year in the late 1990s. But then in the early 2000s, we went all the way up to 2.07 million housing starts in 2005. And then we realized we were building too many. That plunged in 2009 to 500,000 or so. And since the recession ended, halfway through 2009, we've slowly built more and more. But last year, we finished with 1.17 million units started. This year, we're forecasting 1.27 million started. But even by 2021, the forecast is only for as many housing unit starts as we saw in 1994, 5, and 6, when we had a much smaller population. So this is not landmark growth in terms of housing starts. But here's an interesting slide that I think gives you a little more information about the composition of the housing market. The orange line at the top, using the scale, the y-axis scale on the right, shows you the number of people in owner-occupied housing units from 1990 through 2016. And you see that the number grew from 1990 through about 2004, 2005, from about 62 million or so to about 75 million. But then, since 2005, we've been amazingly flat. The number of owner-occupied housing units has not grown at all. It's pretty much stuck at 75 million units. Contrast that with the number of renter-occupied housing units, which starting in 1990 at 34 million, that's the scale on the right y-axis, rose a little bit to about a little under 36 million and then dropped to 32.6 in 2004. And from that point on has been rising almost steadily to the point where at the end of 2016, there were 43 million renter-occupied housing units. And so the composition of the housing market has changed dramatically in the last dozen years. We care about this because renters, only about half of all renters, actually less than half, buy renters insurance, whereas 90 to 95% of homeowners buy homeowners insurance. So this is affecting the purchase and maintenance of property and liability insurance by the different composition of owners and renters. Now, are we going to have more of this? This is the rental vacancy rates measured quarterly from 1990 to now. And what it shows is despite this tremendous upsurge in renter-occupied units, there's still not very many left. Very few of them are vacant. And if you see a chart like this and you're a developer, what do? Well, that means you continue to be building more multi-unit rental units. What this chart shows you that among housing unit starts from 1990 through 2007, something like only 20 to 25% of them in those years were in units of 5 or more as a project. And roughly 80%, 75 to 80% were single-family houses. Since 2008, over 1/3 of all of the housing unit starts were in projects that had 5 or more units. And that continuing in 2017, all I have are data for the first 2 months, but so far that 35%, 32.5% seems to be continuing for now. And again, as I said, given the rental vacancy rate, that's not surprising. Turning from homeowners to auto insurance, we have a situation in which America is driving more again. This is percentage increase in miles driven in 2015 and 2016. Because you scan back to 2000, you see that the rate of increase is now well above what it's been in any of the prior years. And when you put that to why is that happening? Well, one reason is that growth in employment is getting more people on the road and they're driving to work. That's what something like 80% of the U.S. population does. All these people driving at rush hour. That's the blue line here, the number of people employed using the left-hand y-axis. And on the right-hand y-axis, we've graphed the collision claims per 100 insured vehicles from ISO's Fast Track data. And you can see that the match is pretty close. Not surprisingly, more people driving to work, not too many more additional miles of traffic road to drive on. Cars can be bumping into each other, which is what they seemingly have been doing. And as a result of that, what you get is more crashes, claim frequency, and well as severity increasing and so a combined ratio increasingly deteriorating to the point where 2015, the latest data we have for the full year, a 104.6 combined ratio. So moving from personal lines, we've talked about auto and homeowners, to commercial lines a little bit. Industrial production has generally been growing. We had a very weak year in 2015, slightly down year in 2016, but the expectation from the Blue Chip survey is that industrial production will continue to grow with the rest of the economy at a little over 2% per year for most of the next 5 or 6 years here. And businesses will continue to support that growth with continued increases in business investment, not only brick and mortar type investment, but also internet software and other kinds of productivity enhancing long-term investments as well at a reasonably consistent but strong pace, relatively speaking, certainly strong compared to 2015 and 16. One of the things that President Trump has talked about as a way to stimulate the economy is to have a very large infrastructure spending program. I thought what I would do to find out what that would do to where we've been is to graph the infrastructure spending, public and private, that we've had since 2003. I combined spending on 7 infrastructure categories: public safety, transportation, communication, power, highway and street, sewage and waste disposal, and water supply. And that's graphed in this chart. What it shows is that from 2003 to 2008, there was a very strong upswing in spending by a little over $100 billion increase. But it's been pretty steady since then, roughly in the $275 to $280 billion range. So that if we did have a major, President Trump's talking about $1 trillion infrastructure spending activity, that would obviously be a giant impact on what we have been experiencing. However, infrastructure takes a while to go from plans to implementation, so I wouldn't expect to see it all happen at once. I would expect, if it does happen, that it would essentially be the same pattern we see from 2003 to 2008. Finally, in the commercial auto area, essentially the same pattern that we saw for private passenger auto, and for pretty much the same reason. We have many more vehicles on the road in the last couple of years, spurred by the growth in employment, and as a result, we have a deteriorating experience, mostly driven by a combination of increased frequency and increased severity of crashes. Note, however, that the combined ratio for commercial auto is deteriorating even worse than for private passenger auto. So that's the presentation I've prepared for you. I'd be happy to take any questions you may have. We have a question asking that since I've been using third quarter data for the property casualty industry, when do we expect to get fourth quarter full year data? And the answer is that typically that comes in at the end of the following quarter of the one we're interested in. So should be around the end of the first quarter of 2017. We'll get data for the fourth quarter of 2016, more or less, and we'll be happy to update you when we get that data. Any other questions? Got a question as to why I think the downturn in industrial activity in 2016 occurred. And I think the answer, the best answer, it's really kind of hard to say exactly, but one answer that I think is a pretty good one is that at the end of 2015, there was a great deal of uncertainty about whether the Fed was going to raise interest rates in 2016. Initially, it was thought that there would be several raises. As the year went on, that became somewhat doubtful, and in fact, the Fed only raised once in December. And so there was a great deal of uncertainty about where interest rates were going, and a lot of the projects that business investment require is some good certainty about where interest rates are going, because a lot of that is the profitability of those kind of investments revolves around the level of interest rates. For 2017, there's a high confidence level that the Fed will increase rates as much as maybe 3 or 4 times this year. And so chief financial officers and others would tend to be more confident that they can go ahead and plan, because they think they have a better track on where interest rates are going, not just now, but in the near-term future as well. So I think that's as good an explanation as I can offer for why the data turned out to be the way that they have. Are there any other questions? Okay, well, if you have them, you can email me. I'll respond to them as best I can, as quickly as I can. My email address is Stephen W., that's STEVENW, at iii.org. Thank you very much for participating, and that's the end of our webinar. Bye now.